Paying off your small business's debt makes a lot of sense, right? Because debt is bad, isn't it? Hey everyone, it's David Barnett from investlocalbook.com, the blog site and YouTube channel where I talk about buying and selling small businesses, managing small businesses, investing in small businesses, personal finance, and anything else that people send me questions about. I made a video the other day about someone who thought that paying off their business's debt was a great way to prepare a business for sale. And I wanted to address the question again, but this time from the point of view of a business owner and their personal position of wealth, okay? Because a lot of small business owners will get into business and maybe they borrow money or they lease equipment or what have you, and they've got that payment every month. And if they're prosperous and they have profits and money accumulates in the bank, they often look towards paying off those debts as a smart use of that cash because they think that it's going to make them better off not having to be paying interest to someone else. So let's take a quick look at some of the assumptions that underlie that and decide if it really does make sense for somebody to be paying off debt in their small business. Let me draw something on the whiteboard. I'll be right back. All right, so what I've done here is I've drawn a very simple balance sheet, and we're going to assume that we're working with a company that has a profit of $100,000 a year. And we're in a business that has $200,000 worth of assets, $150,000 of debts, and $50,000 of equity. So this represents, a pretty simplistic balance sheet, and it's probably the riskiest balance sheet that a banker might allow because we've got $3 of debt for every $1 of equity. So this is a 3-to-1 debt to equity ratio. Now let's assume that you're taking $50,000 a year out of this business in order to live. So that means that you would have another $50,000 of free cash available to make decisions with. And you could do a number of different things. You could expand the business, or you could take the money out of the business, or you could give some of that money to the bank and pay down your debt, right? So right now, currently, what's happening in this business is you've got $50,000 of your own money, and with that investment, you're generating $100,000 of cash flow. So you're basically doubling your investment every year out of this business in the form of cash flow, okay? So this is a 2 times return on your equity, okay? And small businesses are very risky, and so they often sell for very low multiples. So many small businesses will sell for 2 to 2.5 times their free cash flow to the owner. So right now, this business is generating the kind of rate of return that the marketplace expects from these kinds of small businesses. Let's take the example of paying down debt. So we give the bank 50 grand. So now we only have $100,000 of debt, and we now have $100,000 of equity, okay? Because we've kept that money in the business. So now debts and equities are equal. The banker loves us because now the business is in a much less risky position. We have a 1-to-1 debt to equity ratio, which is a very strong balance sheet for a small business. But we're still only making $100,000 a year because nothing fundamentally has changed in the business. Operationally, it's the same. We just took some of the profits and paid off the debt. But what's happened to our rate of return is we're no longer earning 2 times return on our equity. We're now only earning 1 time return on our equity. So essentially, by taking that money and putting it into this business by paying off debt, we are putting more and more of our money into a very risky asset and actually reducing the rate of return we're enjoying on our own investment, okay? If you were sitting down with a financial planner looking at an array of mutual funds and bonds and stocks and other types of investments, you would be hard-pressed to find a financial planner who would tell you to put more and more money into something that's going to get you a lower rate of return, right? Am I right? Yet, I see small business people do this all the time. And the reason is because they've got this debt aversity. They just think that debt is bad. They don't want to have it. In large companies, big enterprises, they have finance departments. And the purpose of the finance department is to figure out the optimum level of debt versus equity so that they can maximize the shareholders' return on equity. And so that often means for big businesses, if interest rates are low, they'll go out and borrow money and actually buy back shares so that they get to use the cheaper bank debt to leverage their company instead of using their shareholders' money. So oftentimes when you have a small business, it's risky because you don't control all the factors. I've known restaurateurs that have gone out of business because cities have decided to do road work over the course of the busy summer season, and that has killed a perfectly good restaurant that maybe had been operating for 10 years. Things happen completely outside of your control. Government regulation, the actions of a competitor, the actions of a supplier, a change in your town's economy, the major employer closes, all of a sudden all of the stores, restaurants, and boutiques that serve the employees of that industry fall on hard times. So my philosophy about small business is that the small business has to serve its owner and its owner's needs. And what that means is it's got to deliver cash to you and allow you to strengthen your financial position by diversifying your wealth. So in this example, instead of paying off the small business debt, what you have to examine is what other opportunities do I have for that extra $50,000, and does it make sense to take it out of the business in order to invest it somewhere else? Could that be a down payment, for example, in a small apartment building? So now you have another asset with an independent revenue stream, the tenants that rent from you, right? The business could fail, but those people are still going to pay rent. It's a way of diversifying your assets among different cash flows so that if one thing goes bad, you're still going to be in a good position. I think one of the reasons why people often default to the plan of paying off debt is because they're afraid that if they take the money out of the business, they're then going to trigger a tax event. So it becomes income or a bonus or a dividend, and all of those things attract income tax from the government. And, you know, it's true, and that sucks. Nobody likes to pay tax. But if you just pay off all of your business's debt, eventually you're going to pay those taxes anyway when it comes time to selling the business, right? So from the perspective of personal finance, I think that paying off debt is not always the right decision to make. And like I said in the previous video, having the right kinds of assumable debts in a small business can actually make it more attractive and easier for a buyer to buy. If you want to learn more about buying and selling businesses, come on down to investlocalbook.com. Sign up for my email list. Every week I send out a new video and subscribers get to see it before anyone else does. And if you have a business that you're thinking about selling one day, you really should visit howtosellmyownbusiness.com, where you can purchase a copy of my book, How to Sell My Own Business, or download a free copy of my special report, The 12 Things to Do Before You Consider Selling Your Business. There's also a link there to over 75 videos on buying and selling businesses so you can start to learn more about the process. If you have any questions or you'd like to work with me, I work with people all around the world, just give me a call, 506-381-8416. Thanks. We'll see you next time.